Excellent. Right, can I just double check that everyone can see that okay? Yeah, fantastic. Okay, so yeah, just to echo what Jaden said there, thank you everyone for hopping on the live today. It's nice to be back doing these. So, and again, just to sort of echo what Jaden said, it is a more generic approach that we'll be going for today because we want to be looking, well, you can see from the topics, we're going to be looking at the accounting principles, which can be an area I think that people not rush through. I wouldn't go as far as say rush through, but at least sort of they glance at, read through, and then put it to one side because there's no numbers. And I know everyone wants to get to the numbers. So I think what I'm going to try and do today is what I would class as adding meat to the bones, really. So I'll be going through the principles, trying to put them in context and sort of give an example where I can for each one and hopefully bring them to life a little bit. I will give you the opportunity, as Jane said, to ask questions after each slide rather than moving on to the next topic, just so you clear anything up. There can't imagine be absolutely loads of questions on this one, but if you do have anything, please do ask. Right, okay, let's hop in then and make a start. So the first thing that we're going to look at is what's known as the primary users of finance. So we have three groups. We have existing and potential investors, we have lenders, and we have other creditors. So what we'll do is let's look at each of these, think about why they'd be interested in the final accounts, what they get out of it, and what they're sort of going to look at for each of these. So we'll start off with existing investors. So why would an existing investor want to see the final accounts? Well, as I'm explaining this, obviously try and think about from your own perspective why they may want to as well. So the first reason we'd have is to measure performance. So if you're an investor within a business, obviously you want to see that business is performing well. For multiple reasons. The main one being, if you're an investor, you may want to see some sort of financial return in the form of dividends. So they would want to measure that business's performance to make sure that they're on track, meeting their targets, because there'll be targets set out at the start of the year. So it's trying to make sure that they are meeting those and moving with the market. Now, the next reason, obviously, they want to look at the safety of their investment. Is this the right investment for them? Because it may be that they take the money that they have invested and they put that in a different company. So one of the reasons would be to make sure that their investment stays safe. Now, from a potential investor's perspective, and it may be that some of you watching actually do invest in the stock market. That's not a plug or a suggestion, but you may do. Think about what you'd be interested in seeing from final accounts, because when you're picking, whoever it is that you're investing into, obviously we're not going just based on nothing or just picking at random. Otherwise, you end up picking someone potentially that isn't great, such as could be Wilco. I don't know if that's too soon. But think about the past performance, and you would want to see how stable is that business. And that leads into, risk appetite, and we'll not go into that in too much detail. But think about, such as companies such as Coca-Cola. They've got an extremely long history. They've been going for nearly 140 years. And you've got financial information from a huge range over that time. So you can see the stability of that business. Now, it may be that you want to look at more sort of risky investments, such as a tech company. But again, using those final accounts, that would provide that information for you, because you can look at the profit, you can look at the statement of financial position, you can have a look at the cash flow statement to make sure that their liquidity is good. So there's a number of things that you would use as an existing or a potential investor from the final accounts to be able to make your decisions. Okay, now the next one on the list are lenders. So the main lender, there are different options here, but the main lender that we all probably think of are banks. Okay, so if a business is going to apply for a loan, and that could be for a number of different reasons, it could be that they need the money for cash flow purposes, not generally the best reason to get a loan, but it may be that's what they need. It may be they want a loan for investment purposes, such as buying a non-current asset. Now, when you go to a bank to get that money, obviously they don't just give it you. I mean, that'd be lovely, or not really, because it'd be a bit concerning. But they would want to see, alongside your business plan to show how the money would be used, your accounts to see how stable you are, and to make sure that what you've got in your business plan ties up with what's in your accounts. So when it comes to lenders, such as a bank, again, they need that information from your accounts to be able to use for their decision making. Now, that is a theme that you're going to see come up quite a bit throughout the presentation, that a lot of this information is based on people making decisions, which leads into accuracy of the accounts, etc., which we'll come on to. Now, this entire process is known as what's called called due diligence, which is where you are looking into a business or doing your financial health checks to make sure that they are a viable business to work with or lend money to or invest in. Now, the last one on that list is other creditors. Okay, now other creditors, your typical example here would be suppliers. Okay, and there's a number of reasons why suppliers might look into your final accounts. Again, related to stability. Now, a lot of business-to-business transactions will be done through credit. Okay, so it may be that you've asked that supplier that you need an increased credit limit, or it may be that you're being set up newly, and they want to do their due diligence, their final check, their financial health checks, based upon your financial statements, to make sure that you're credible in order to lend to. Okay, I mean, even thinking about lenders, if anyone's watched if anyone's watched The Apprentice, you'll know from their business plans that they do at the end. If you've not, don't worry, that they absolutely shred them, and it's being able to provide solid financial statements that make sense, and like I say, we'll come on to that shortly, in order for people, businesses to make those decisions. Okay, so that covers the primary users of final accounts. Could we just check in, Jade, and see if anyone has any questions on those?
Yeah, so we'll do it, we'll wait a little bit just to see if we do have any questions, but I'll just say, if you guys do have any questions, just write them down in the comment section. We'll wait about 30 seconds to a minute to see if there is anything. If not, then we will just proceed from there. So
no problem.
Not seeing anything so far. What I'll say is, go ahead. If we do get anything, I'll just pause you, and then we'll answer it from there.
Excellent. Yep, no problem at all. Okay, so the next thing that I want to look at is the accounting principles. And again, I'm hoping you've heard of some of these. If not, don't worry, because I'll be explaining them in full. Now, it's really important to be able to understand what these principles are. Okay, and I fully appreciate that when you're learning, you want to focus on the numbers. I get that. That was me when I was doing my AAT. I do understand that. However, it is really important to understand these concepts, not just for the purposes of the exam, but it will actually help you understand when you're doing your double entry, etc. By understanding the principle, it will actually really help with that side of it as well. And if you do go on to level 4 and you've got a number of written questions in each exam, again, being able to explain these concepts is really important. Okay, so let's have a look at the three that we'll be going through. Well, let's start off with accruals first. So accruals is an absolute classic for level 3. It's a topic that traditionally a lot of people have struggled with. Once you get it, it's dead straightforward, but it is definitely one of the harder ones to get your head around. So if you're sat at home thinking, I just don't get this, you are definitely not alone. We're not going to be focusing on the double entry today because it's the principles, but let's think about what the accruals concept actually is. So the accruals concept states that the transaction, or the financial transaction, is to be recorded when the goods or services occur, i.e. happen, not when the money is paid or received. So if you're recording transactions when the money is paid or received, that's what's known as cash accounting. Okay, and we won't be going into that in today's session. However, the majority of businesses and the businesses that you will more than likely work with will use what's known as accruals accounting. So accruals accounting is all about recording that transaction in your accounts, as I said, when the goods or services are received or take place, rather than when that money is paid or received. Okay, because what that means is, for a start, your accounts are then accurate. Okay, the stuff that relates to that financial period is recorded in that financial period, which is why it's sometimes also known as the matching concept. Now, putting that into, I suppose, a more simple example that some of you, or the vast majority, will probably understand. A typical example would be insurance. Okay, for anyone who pays their car insurance up front, that car insurance lasts for 12 months. So it's a really typical example, this. So let's say your financial year runs from January through to December. Let's keep it really simple, in line with the calendar year. Now, the chances are when you pay for that car insurance, it doesn't happen to fall that it goes from January to December. It might do, but the chances are it won't do. Okay, now if you pay for that up front, let's say that car insurance runs from April through to March, so 12 months. But that doesn't follow your financial year. Now, if that's paid up front, let's keep the numbers simple. Let's say it's £1,200, so it works out at £100 a month. What you could do is record that £1,200 in April, right up front. Okay. The problem with doing that, and that's how it would be done if it was cash accounting, the problem with doing that is then you have an expense that's in there for £1,200, that's all gone into April. Okay, but it doesn't all relate to April. Okay, so the accruals concept, what we would do is we would have to move that amount to the relevant months that it related to. So if it's £100 a month, we want to show that expense relates as £100 each month. So obviously part of that transaction would move into the next financial year. And that's how accruals accounting works. So that when someone looks at their statements, it could be, even within management accounting, if you've got a manager looking over those statements, they don't see a £1,200 expense within that month because it doesn't all relate to that month. It relates to a number of months. So by using accruals accounting, it's a more accurate way of showing what actually relates to that particular month. Now, for insurance, yes, that's a small amount. It's not necessarily material. That's a nod to what we'll be going over later. We're looking at the materiality concept. But for bigger things, such as it could be rent, for example, where it's a much more significant number, you need to split that out. Otherwise, it's going to look really odd in your financial statements. Okay, so hopefully that somewhat clears up the accruals concept if you weren't too sure on that. So the next one we're going to look at is going concern. So the going concern concept states that financial statements are prepared on the basis that the business will continue as normal for the foreseeable future. And that would, just for context, realistically, that as a minimum will be 12 months. Okay, because your financial statements are, without getting too complex, they're more than likely going to be for 12 months. Okay, and anything at this stage will be for 12 months. So if a business is a going concern, your financial statement should be prepared as though the business will continue as it is, roughly as it is, for the foreseeable future. Now, an example of where a business is no longer a going concern would be typically if someone is retiring, it could be, and the business is therefore going to close down, or if the business is going to go into liquidation. At that point, the business is classified as no longer a going concern. Now, you might think, well, why does that matter in terms of the accounts? Well, actually, if a business is no longer a going concern, the accounts are prepared in a different way. Okay, because there's certain items within our accounts that are purely done based on accounting rules. And a really typical one here that I'm sure a lot of you have done or have at least heard of is depreciation. Okay, think about how assets are valued in your accounts. It's the cost less depreciation. Okay, now that is a rough estimate of what that asset is valued at. However, if your business is no longer a going concern, you would no longer value those assets in that method. Okay, at that point, what you would do is you would value them, and this is the same for inventory. This exact same principle applies. You would value them at what you can actually sell them for. Okay, now if the business has gone into liquidation, you're going to try and wrap up that business, sell off the assets that it owns, and pay off as many people as you can. Now, what that means is the chances are those assets are going to drop in value. Okay, so that they would no longer be valued as they would be if the business was a going concern. Okay, so again, I hope that sort of gives you an idea of what would happen if a business is a going concern and what would happen or what changes would occur if a business was no longer a going concern. So the next accounting principle is business entity. So the business entity concept basically means that financial statements are prepared from the perspective of the business. Okay, so we're not mixing personal and business transactions together. Okay, now for a limited company, that might be a little bit easier, but particularly for a sole trader, the line shouldn't, but could get blurred. Okay, so it's making sure that the financial statements are prepared just based upon the business's transactions, not the personal transactions of the owner. Okay, now a typical example there would be something like, and I'm hoping you did this at level 2, is where the owner puts in capital to a business. Okay, so they put in their own money, usually when the business starts, but it could be later on as well. They put their own personal money into the business. Once that's done, that transaction is recorded in the business's accounts. Okay, we would increase the bank balance and we would show the capital against the owner. Okay, it's no longer the owner's money from a personal perspective. Okay, so that is really, really important when you are preparing final accounts, particularly, and it particularly comes into play when it's a small business. Okay, because especially when they don't understand that, if you are preparing that person's accounts, you need to be aware of that because you would need to then explain that to that individual. Okay, so when they're giving you receipts related to last night's dinner, okay, unless it is specifically for business, they can't have that transaction. So the business entity concept, very, very important. Applies to everyone, often can get confused for a small business. Okay, I think that covers that. Again, I hope that sort of gives a little bit of context to what business entity is. Jaden, I'm going to come back to you. Has anyone got any questions at all on what we've covered so far?
Nothing so far. I think everyone is very locked in at the moment, but we will again pause for a brief moment just to see if anyone has any questions on anything that was covered. So accruals, going concern, and business entity. If you need us to go over anything in relation to that again, or if you've got any questions about it, now is the time. If not, then we will proceed. Bridget says she's busy taking notes.
Yeah,
Yes, that is definitely the way forward.
yeah,
But yeah, again, just a brief pause and we will see if
yeah.
we.
No problem.
Oh, we've got a question from Marta who's asked, what about materiality? Or,
Materiality. Yeah,
yeah,
yeah. Don't worry about that. That will be on the next slide.
okay, that's on the next slide. And Daniela asks, aren't there two more?
Oh yeah, we're not done yet. Yeah, not done
Okay, yeah.
yet. Don't worry. I love the anticipation though. I do appreciate that.
Yeah, perfect. And Chloe says, as a seasoned accountant, your explanations are perfect.
Good. Excellent. That's nice to hear.
Yeah,
I feel
I
like
think
that's a lot of
everyone.
pressure to keep up now, but it's when we
No,
get to the
you're
next set
doing
of
great.
questions and it
You would.
turns to that was awful. But
And
anyway,
so quickly, Tanya, you can find the slides at the top. So they are pinned to the top of the chat box. If you just go up there, you'll find the slides. You'll be able to access them from there. But I do think that is everyone. So, yeah, more than happy for you to proceed when you are ready.
okay, let's go for materiality. Okay, so materiality, which can be a mouthful to there. Now, it's an interesting one, this, because there is actually no single definition. So wherever you look, you will actually find different definitions. However, the concept remains the same, even though the definition does differ slightly. Okay, now in terms of the conceptual framework, which includes all these different principles that I'm going through today, it does have an overview of what that is. And I'm going to try and simplify this to make it, as easy as possible. What we need to think about when it comes to materiality is, and the financial statements, will it have an impact on the decision making based upon those financial statements? Okay, and it'll become a lot clearer when I sort of talk about examples for that. So think about, a huge business such as McDonald's. Okay, now if they've got a transaction, they're preparing their final accounts. Okay, and they can't find a transaction for £500. Does it matter? No. Okay, realistically, no. Yes, there might be an internal, look at their controls, but overall, okay, £500 on their financial statements, bear in mind, they're going to be shown in millions, is not going to have a huge effect. Now, we can apply that to different areas, because what that does mean for materiality is it is relevant to the size of the organization. Okay, now, granted, I'm going to go quite extreme here, but let's say someone's revenue was £10,000 and they were missing a transaction related to their costs or revenue related to, £600, £700. That's a huge proportion then. So for that business, it is material. For McDonald's, it's not material. Okay, so what we need to think about, is it going to have an actual impact on the financial statements? Okay, and that would even come into place when we think about capitalizing assets. Let's think about capitalizing assets. Different businesses, there's no set limit to say you have to capitalize an asset if it's over £100 or £200. The business will have its own rules on at what point they capitalize an asset. And for one business, a larger business, that will probably be higher than what it will be for a smaller business. Okay. Another example, let's even go back to nominal codes. Okay, think about your accounting system if you work on an accounting system. If not to worry. Okay, it'll still make sense. Think about recording your transactions. Okay, we will categorize certain transactions into one account. We don't have a separate account for every single transaction because that would be absolute madness. Okay, so it may be that we group stationery together because it's completely unnecessary to have, an account for paper and an account for paper clips and an account for a hole puncher. That your accounts would be 47 pages long. Okay, so we have to think from a materiality perspective, what fits together. Okay, this, when you do level 4, for those who do level 4, this applies even more so because you're looking at bigger companies. But think about what fits together and group those into one account. Okay, that it still forms part of your materiality concept. Okay, think about reconciliations. I'm hoping most of you did the bank reconciliation at level 2, but there are other reconciliations that are performed as well in accounting related to the balance sheet. Now, granted, the bank rec is one on its own because we kind of do want that down to the pound, but there are other reconciliations such as non-current assets where you're reconciling what's in your accounting system to the non-current asset register. Now, if you're a pound out, don't worry about that. Okay, it's not a huge deal. If you're £10,000 out or £100,000 out, obviously that needs investigating. Okay, so again, it's applying a little bit of common sense as well when you're looking at materiality to see what will have a true impact on the financial statements. Okay, the next one on the list is consistency. Nice and quick consistency. It's all about using the same accounting techniques. Okay, think about the accounting techniques that you've learned so far during your AAT. Think about inventory valuation, FIFO, LIFO. Not that we can use LIFO for financial statements before someone states it, but you could use FIFO, you could use AVCO. We don't want to be changing that every year. Okay, same as depreciation. We know there's different methods of depreciation. We could do it on a straight line method. We can do it on a diminishing or reducing balance method. We can do it on a units method. If I'm being audited or someone's reviewing my accounts and they see that every single year I change the way in which I value something or change the technique, it screams, well, this is odd, okay, and would need further investigation because it looks like you're manipulating something at that point. Okay, so consistency is about using the same accounting techniques. I'm not saying it can't be changed, but doing it year on year would not be, for a start, would not be the best use of resources, but also just plainly shouldn't be done. Next on the list is Prudence. Now, Prudence left the syllabus a while ago, but glad to see that it's made a comeback because it is really important. So the Prudence concept is all about being cautious. Okay, profits should be recorded if they've happened. Okay, gains should be recorded if they've happened. Revenue should be recorded when it's happened. However, losses should be recognized if they are likely to happen. Okay, so the Prudence concept is all about being cautious. Okay, whether that's reviewing someone's accounts, and we'll dig into that a bit later, or preparing accounts yourself, the whole idea is to look at things from a cautious perspective. Don't go in with the sort of attitude of, well, it might happen. It probably will. Okay, we don't want to do that. Okay, we always want to err on the side of caution. Okay, right, next one on the list is money measurement. Okay, fairly simple explanation for money measurement, and one that didn't used to be in here, but again, glad to see that it's made its way in. Only transactions that have a monetary value should be included in the accounts. Okay, now you might be thinking, well, what else is there? what other things other than monetary transactions would be included in the accounts? There are other things, okay, they're not obvious, and it's probably not something you would automatically think to put in, but there are other things that have extremely, actually huge value to a business, but they don't have a monetary value to them, and therefore shouldn't be included in the accounts. If you think about an employee, who's worked there for a number of years, who's built up a huge amount of experience, think about an employee or a workplace that has a great working atmosphere. People really want to go into work. They really want to do a good job. They're motivated. That has a huge value to the business. Huge, absolutely huge. But you can't put that in the financial accounts. Okay. And I don't want to get into the whole goodwill, which you will do later on, but not right now, where intangible assets do come in. But for now, okay, you cannot value that within your accounts. You can't say, well, they do a great job. They love coming into work. Let's whack another 10 grand in the accounts as an asset. We can't do that. Okay. It's great for the business, but it doesn't have a monetary value to it. Okay, so again, I hope that adds some explanation to that, and that does cover that particular slide. So Jaden, again, have we got any questions related to those?
We do have a question. Of course, again, just want to highlight if you guys do have any questions. We've just covered here: materiality, consistency, prudence, and money management. Now is the time to get it in. But we do have a question from Carla, who was asked, for capitalization, even though you've set the limits, can you decide to group them? She said, let's say, for example, an office refurbish, instead of capitalizing each chair for £100, which would not reach the materiality for assets, would it be okay to group them together? For example, if you did 5 chairs, would that reach the £250 limit, or would it have to be done individually?
So the simple answer to that is yes. Okay, and I remember coming across a very similar situation. I don't want to go on too much here because I'm going to end up going over time, but I actually came across this situation myself and had to talk to Grant Thornton about this, because what the situation I had when I was working in accounts is we bought 150 keyboards. Okay, and they were quite expensive keyboards as well. So you might think it's only a keyboard. Actually, the financial value as a collective took us way over the limit at the time. Now, the way that we then recorded that is we recorded it as a group. Okay, you wouldn't record every single keyboard separately because that would be madness. What we did, we grouped the value together, and then we depreciated them as a group. However, in the non-current asset register, what we then did is we had that information on that group of keyboards. So it said the number of keyboards that we bought, and we then had a list, which the poor old IT person spent about 2 days on, where they then recorded every single serial number for each keyboard, just in case, because we used to have an audit each year, we were audited and we could track those back. Okay, so the simple answer is yes, you can do that.
Okay, perfect. We've got a question here from Rebecca, who was asked, have prudence and money management come back in Quals 22?
Yeah, so the thing with the reason why I didn't like prudence going in the first place, and I used to teach it even though it wasn't in the syllabus, is because it's so important to understand that concept anyway. Okay, forget the exams. Okay, take that away. Okay, it's such an important concept to understand in accounting. And yes, I know we want to pass the exams. I fully get that. But we are also trying to learn what important as well within accounting and improve, you know, in work. And that in Prudence is really important. But yes, they are back to answer that question.
Okay, perfect. And Daniela has asked, when it comes to grouping, can I group it by item and not supplier? So for example, if I have a vehicle fuel nominal code, can I put it, but put any petrol station through it? So like Esso, Shell, BP.
Okay, so on this, I'm not going to advise on this one. And the reason is we start getting into examples which are maybe too specific and related to work. And I'm just not, as a tutor, I'm not able to actually give advice in that. Nothing wrong with asking the question. Absolutely, don't feel bad asking. But I'm not able to advise specifically on that scenario. We just have to be a bit careful that we're not too specific on what we advise on, and hope you understand that, if that's okay.
Yep. No, that's no worries at all. Savita has asked if you can briefly go over Prudence again. I'm unsure time-wise, if we have time for that. Do you think that there is sufficient time for that? If not, these sessions are recorded, so we'll be able to go back over that again.
I'm just looking at my sheets and I'm thinking, unfortunately not, because we have got a bit to get through yet.
Yep.
So apologies.
Yep.
Probably
No,
best to watch it back on that one.
Yeah, that's no problem at all. Again, these sessions are recorded, so if you've missed anything, you are able to go back and re-watch it and get it that way. But yeah, I would say when you're ready, yeah, let's proceed.
Brilliant. Okie dokie. So the next thing that we're moving on to is the fundamental qualitative characteristics of accounts. And this runs through all levels, all the way up through chartered exams. And these are relevance and faithful representation. Okay, so let's look at what each of these actually mean, because it is very important that you are able to explain each of these. So be able to understand it and explain it for yourselves. Okay, so relevance actually means, it's kind of in the name, but the financial information is relevant if it is capable of making a difference in the decision making by the user of that information. Okay, I know that's a bit of a mouthful. Okay, remember, all this is in relation to financial statements. Okay, so if something is relevant, i.e., if it's going to make a difference to someone's decision-making process, then it should be in the accounts. Okay, as an accountant, that would be part of your job to make that decision. Okay, the chances are it does need to be in there. Okay, but that is what relevance specifically means. If it will affect someone's decision making, then it needs to be included somewhere in the accounts. That could be within the figures, it could be within the notes to the account to explain why something is in there or why it's not, etc. But it needs to be in there in some capacity if it can affect someone's decision making. Okay, now the other one, okay, faithful representation. In simple terms, do the financial statements reflect the business? Okay, and the whole idea of following faithful representation is that your financial statements represent that particular business. They are reflective of that business. And we do that, or we sort of achieve that in three ways. So they need to be complete, okay, fairly obvious, okay, don't miss a big chunk out. Obviously, that's not going to be representative of the business. They need to be neutral, i.e. unbiased, okay, so they need, you know, I'm sure you've done it or touched on objectivity at some point, okay, so they need to be neutral, okay, so prepared neutrally. And lastly, free from error, which I get that that's fairly self-explanatory, that they should be free from error. But what we do need to understand is that in accounts, the chances are It's not absolutely perfect. Okay, bear in mind, we've got thousands of transactions that are recorded, and some adjustments are accounting adjustments. Okay, so they are as close to what we expect. Think about depreciation. Okay, they are as close to what we expect as possible, and that is the industry standard in terms of how we should treat them. But that doesn't mean it is 100% perfect. We're just aiming for as close to that as possible. Okay, so they should be as free from error as possible. They should be as neutral as possible. Okay, every single person in the world will have some sort of bias towards something, but the accounts need to be prepared as neutrally as possible and complete, i.e., we are including everything in there that needs to be included, which links back to relevance. Okay, brilliant. Okay. Right, what we're going to do, we'll move straight on to the enhancing qualitative characteristics, because what these do, so they are our fundamental qualitative characteristics. Okay, don't try and say that 5 times too fast, no chance at all. What we then have is we have backup ones. Okay, so these are the enhancing qualitative characteristics now. So we have comparability. And comparability, all that's referring to, and again, it's in the name, is the ability that you should be able to compare two things. Okay, you should be able to compare the same business year on year. Okay, so there shouldn't be a huge change in the way that their financial statements are changed. Okay, the figures will change, you see the notes, the account will change, but the actual format should stay very similar. And what that allows to do, if someone comes along, that could be an auditor, it could be an investor, as any stakeholder, they should be able to look at your financial statements and compare between years with relative ease. Okay. Again, if you don't do that, it looks like you're trying to hide something. Okay. The other one is actually, you should, in theory, due to the fact that we have international accounting standards, IFRS and UK GAAP, whichever you use, you should be able to compare between businesses of a similar type as well. Okay, so if you're in the same industry as somebody else, there'd be no major reason why your accounts look vastly different due to what we have in place, the rules, or at least not necessarily rules, but guidelines, which I've just gone into Pirates of the Caribbean quote there. It should be prepared similar each year and to each business. Okay. Now the next on the list is verifiability. Okay. Now this comes into play in 2 different areas really, because what we need to be able to do is, we spoke about materiality and being able to group figures together. And in the financial statements, that's what we're doing. We're going to group certain figures in certain categories and show those on the financial statements. We don't list every single transaction out. However, if someone were to say to you, the person who'd prepared them, right, I want a breakdown of that figure. How did you get to that figure? You need to be able to say, yeah, okay, I've got the backup for that figure, and there should be a list of every transaction that makes up that figure. Okay, if someone comes to you and says, right, how did you get that figure? And you go, I don't know. Or, okay, that's no good. Obviously, that's no good. Okay, you need to be able to back up those figures with how you've been able to get to them. The other side to that is that with that backup, somebody else, an independent party, it could be, or someone else who works for the same business, they should be able to look at that information and be able to basically come to the same conclusion, i.e. the same figure that you have. Okay, they shouldn't be getting something vastly different because something's gone wrong, isn't it? If you've got 3 or 4 people all getting different figures for this, what should be the same figure, then something's gone wrong. So that is verifiability. There's two sides to that. The next on the list then is timeliness. Now, yes, there are rules in terms of when you need to submit your accounts, and at this stage we don't need to be aware of that. However, there are rules on when you need to submit your accounts. Obviously, the sooner they are prepared and the sooner that information is available, the better it is. Okay, it's no good if you think about making a decision based on those accounts, whether it's be investing or whatever it may be. That's no good looking at accounts from 4 years ago. Okay, the whole idea is that they are as up to date as possible. Okay, because the more up to date they are, the better that information and more relevant that information is for the time that you are actually looking at them. So the sooner we can get that information to be available, even if it's not published, but they have access to at least the preliminary financial statements, then you can make decisions based on as up-to-date information as possible. And then the last one on this list is understandability. Okay, now again, it's in the name, but how is it technically described? Well, it states that financial statements should be clear and concise. Okay, so we should have everything that we need, and that's important. We've already said that we need everything that we actually need in there, but nothing extra. So everything needs to be explained, and the excuse of, well, that would be too complex to explain is not a viable. Okay, so even if it's very, very difficult to understand, there is an assumption that the person looking at the financial statements will have enough financial savvy, for a better word, to understand them. Okay, so we need to have everything in there that we need to make them make sense, but nothing extra. So we don't want to be putting in stuff that would potentially cause confusion or is there to mask maybe something else to cover it up, in essence. But we need the notes in the account to explain, how depreciation is calculated, what method, what inventory valuation method. They need to be in there to help the person understand how they've got to their figures that they've got to. But we need nothing else. Okay. And the last part that I want to go through, and then we will go back to questions. Okay, just 2 points really that are both very important and are covered within the AAT syllabus for this unit. We've got the importance of ensuring financial statements are free from material misstatement. Okay, all that means it's nothing really new. It's just a new way of phrasing it, but I want to make sure you've seen that phrasing. The statements are as accurate as possible to make decisions. No one, well, I don't know, there might be some people out there, but not many people are looking over financial statements for fun, let's be fair. Okay, they're looking over them for a reason. Okay, if anyone does look at them for fun, you're more than welcome to. However, we are looking at them for a reason. Okay, and that's why it's important that they are so accurate. Okay, because they're going to be used for some reason as well. Okay, so that's all free from material misstatement means. And then the last point, the importance of the accountant's fundamental ethical principles and professional skepticism when preparing financial statements for users. So in terms of what this means, it's basically using your professional judgment and to some extent curiosity, okay, to question if something doesn't seem correct. Okay, and there was an example that I'd looked at, I can't explain in full because I've just not got time, but where this guy was basically he was making around 90,000 from hiring out fairground rides, I think it was. And it was great examples. They were making around 90,000 revenue, but then they got costs related. I think it was about 62,000 that they were inputting related to consultancy. Okay, now I don't know what £62,000 worth of consultancy would be to implement hiring out fairground rides. Okay, but that's where, and it was falsified records. Reading through the story, but that was a great example of where the accountant had to step in and sort of say, right, explain to me, and you have the duty as the accountant to do this. You need to question, well, why are you spending that, or what's the breakdown of that money? What does it relate to? Rather than just taking it at face value, even if there's an invoice, that still doesn't mean you wouldn't question it to make sure that it is legitimate. And that really is what professional skepticism is. Okay, so that does cover, I think I've just about brought that background in time, okay, everything that we need to for the session. I'll hand back to you, Jaden, to ask if anyone has any questions.
There is a question. We are running quite low on time. I'll ask the question just to see if there is enough time for us to go over that very quickly, but I also need to wrap up. But Eleonora has asked, I'm just going to try and paraphrase this, like if I've made an error and this error has affected financial statements and financial results in the past, how can this error, or how can we correct this error in the current period?
Okay, so this is not something you'll have to do technically not for level 3. If it's related to the same financial year, you could just fix it in whatever period you're in, okay, and make the people who are looking at those, particularly management accounting, when you're doing this month on month, okay, then if there was an error in a previous period, you would fix it. Okay, in the current period, you would make everyone who needs to be aware that that's happened, and that would be fine. If it's from financial statements from a previous year, it gets very complex, and I'm definitely not going to have time to do it now. But it is something you will learn at level 4 if you do level 4, and the actual ruling around that is whether it's what we call an adjusting event or non-adjusting event. That will also have an impact on whether it is material or not as well. But there are certain things where you would have to change your financial statements retrospectively, and some things where you wouldn't. Okay, but you will not have to do that at this stage.
Okay, perfect. Yeah, no, many thanks. I think that is it. We definitely need to start wrapping up there. Yep, Eleonora says great, thank you. So she was happy with that. So yeah, just gonna start wrapping up. I do want to thank everyone for joining and being a part of this Facebook Live. Do remember that these sessions are recorded, so you will be able to rewatch this live in the case that you missed it. This will be available on Facebook, but will also be available on YouTube. Our YouTube is at your AAT. For additional content, news, and memes, do remember to follow our Facebook if you haven't already. But you can also find us on Instagram, you can find us on LinkedIn, Twitter, and you can find us on TikTok as well. But yes, again, thanks everyone for joining, and I will see you next time. Oh yeah, and of course, apologies. Let me give a huge shout out to Will and Training Link as well. We want to thank you guys for being a part of this. Again, you can find Will on YouTube as well at Will Boardman. Huge pleasure, and you will likely be seeing Will again. But I do believe that is it. Again, do want to thank you all for joining, and I'll see you again soon. Bye for now.